the perspectives beyond venture capital. Our moderator is Nola Masterson. Nola is the Managing Director of Science Futures Management. She's had an extensive career in venture capital as an entrepreneur and as an investor. She was the first biotech analyst on Wall Street and co-founder of Sequenome. In a word, a trailblazer. She is a venture partner at Portfolio Femtech Funds and works with Boardwise to train boards of directors. She sits on 3 startup boards and 1 publicly traded biotech board. Please join me in welcoming Nola and our panelists to the stage.
Thank you, Kelvin. I'm delighted to be part of the summit today and bring you this distinguished panel to talk about what's beyond venture capital. I'd like to ask our panelists briefly to introduce themselves, and I'm just grateful that Monica teed us up so well to say there is life after death on Wall Street. Chris, we'll start with you. McFadden.
All right. Well, good morning. It's a pleasure to be here and to be it was such a thoughtful group and in such a beautiful part of the country. So thank you for including me. My name is Chris McFadden. I'm a managing director with KKR based in our San Francisco office. I lead our healthcare finance business, which was introduced by Nola, deals with later stage life science, healthcare delivery, healthcare services organizations, and look forward to being part of today's panel.
I'll just go ahead and go. My name's Geoffrey Loos. I'm a managing director with CapM Advisors. I'm a advisor to healthcare technology companies throughout their life cycle. We generally get involved with businesses early on, but after seed and Series A, and more towards capital raise and M&A environments leading into public offerings within the sector. So based here in Utah, so another beautiful, warmer day here. Excited for spring to finally be upon us.
So I'm Chris Mayo from the London Stock Exchange Group, and you're probably wondering why is the London Stock Exchange Group here? I get that question a lot. I'm actually based in New York, and just to give you some background on LSEG, as we like to refer to ourselves, we're actually very important systemically in the US. We own a number of businesses that you're probably familiar with. So we own Russell, so the Russell 2000 is our product. We also own Refinitiv, so that is the big competitor to Bloomberg. So you either have a Refinitiv terminal or you have a Bloomberg terminal, so we own that business. And we also own LCH, which is the biggest clearer of interest rate swaps by far in the US. So we are a systemically important business. I'm based out of New York, but what I do is something specific, which is I get companies from the US and Canada to IPO in London, which actually happens a lot more than people think, and it happens in healthcare. And the attraction of doing that is we have a focus on smaller companies, kind of 50 million to 500 million valuation is where we're typically focused. Because it's cheaper to go public in London, and also because the investor base for smaller micro caps is very high quality in London. And we've even had companies from Utah. In fact, one of them is speaking this afternoon. Renalytics are speaking, and they did their IPO in London a couple of years ago before subsequently listing back onto NASDAQ. So I'd like to, talk about how we can help smaller med tech companies in particular. And just to give you some background on me, I'm an investment banker by background. I first moved to the US in '99. And so my expertise is around things like IPOs, direct listings, and de-SPACs.
And I want to mention that our fourth panelist, Chris LaPuma, had to excuse himself. His wife is the legal counsel for Signature Bank, and he was having to stay home and take care of the kids. And I wanted to share that story with you because I think it's very charming. And I want to just say a little bit about Fortress because we had a good pre-conference call. And Fortress is an IP lender, And so if you have really good IP, you want to reach out to Fortress because they will lend financing on a capital that's got some good IP behind it. So I think that's another way to monetize venture-backed companies is to look at your IP as your family jewels. And this also, there was a royalty venture capital firm that used to do the same thing, bank on the IP. So we'll get started with who we have here on our panel. And KKR is a well-known, older, group of men, mostly men. And I'd just like you to give us an example of who in the audience could come to you and you would want to work with them, if you have one.
Well, I'd like to say we are broadly diversified by any number of elements, but yes, we were founded by 3 men 45 years ago. Today, our firm manages about $500 billion worth of assets. So, I think we have been good stewards of that capital, and our limited partners have rewarded us. The firm started as a traditional buyouts. Everyone remembers the RGR Nabisco story and all of that. And today, we span across 8 different investment strategies: buyout, growth, energy, infrastructure, credit. And so we have a number of different ways that we can support companies. We do not have a venture capital expression of our investment strategies. We obviously work with a lot of venture firms, and in many cases, venture firms are identifying super high potential companies that are reaching a commercial inflection stage, and that becomes an appropriate time for us to consider, is there a way for KKR as an institution to support that organization's next stage of growth? That for us is typically an EBITDA positive level of performance, suggesting that you've gotten well into some level of both adoption, reimbursement, and some of the other key milestones that I know everyone here is familiar with.
Okay, and CapM, as Jeff has explained, does more of a brokering. Can you give us an example of a company you've worked with that maybe would resonate with this audience?
Yeah, sure. We do a lot of strategy advisory as well as just mergers, acquisitions, and capital raises. So we're generally aligning with the company to help them think through what's the next step. So we, similar to KKR, we don't get involved more on the venture side just because we like a lot of those funds to go directly to the company and we don't want to take a piece of that. So what we try to do is align ourselves with companies who are trying to get beyond that to their next stage. And so we've worked with a lot of different companies that are a little bit more commercialized, sometimes break even, sometimes almost there, and often generating good cash flow for the business. So a lot of our companies, one in particular that we represented on the sale to KKR was 1-800-Contacts here in town. And that was a much later stage and more kind of medical device, medical product sold direct to consumer. So that's a little bit further down. But we've also worked with companies like a Sonsini Bioscience. They're more of a lab equipment and technology business, or a company called Nelson Laboratories. Nelson Laboratories works a lot with med tech, med device, pharma companies around the microbiology side. So that company, maybe both 1-800-Contacts, who we've sold and worked with on a number of different projects, is a little bit later stage. Nelson Labs is kind of a middle market company that we sold to a contract sterilizer, Sterigenics, and then an earlier stage lab equipment company like Sonsini Bioscience would be a smaller, lower middle market company that we've worked with.
Yeah. And Chris, you gave one example of one company that you took public on the London Stock Exchange. And is there 2 stock exchanges in London? Is there a big one and a little one? Can you explain that?
Yeah, that's right, Nola. So I think we do have a diversity problem because we managed to get 3 Chris's on the panel actually. So I'm glad that we managed to get over that. So to answer your question, yes, we have both a growth market and a more established market. The growth market is called AIM, and it's been going for about 27 years now. And we also have the main market. Main market's for larger companies. So most of the time when I'm talking to US companies, I'm talking about AIM because it's really focused on companies who are below $500 million of market cap. And what I would say, I think in contrast, obviously we love cash generative companies as well in London, but I think probably in contrast with the two other panelists, we also deal a lot with pre-revenue companies, especially outside of biopharma, so other areas of life sciences, such as, tools, diagnostics, devices. We've had a number of companies that were pre-revenue that have gone public in London. And so there is an overlap with what we're doing in venture capital. Some of those businesses will have been venture capital backed, and we've helped them to diversify funding sources. We've enabled the VCs to take some money off the table in certain instances. And other examples of companies that have been able to do this, just to make this more concrete, Maxite is a good example, which is a company from Gaithersburg in Maryland. They actually reported results today. They listed in London in 2016, did a number of follow-ons, also got some private investment from Sofanova, of a name which I'm sure is familiar to most people in the room. And then listed about 18 months ago on NASDAQ and raised another $200 million. So we can help be a stepping stone back to the US markets. As companies get bigger, then we can help, we can support them in various follow-on funding stages, and then they can list back into the US when they're the right size. Another example would be a company called Bellascura, which is from just outside of Dallas. That's a medical device company. Pre-revenue but commercial stage, so they had an approved product. They were able to do an IPO about 2 years ago, and a year later they came back and did a follow-on. They're trading around about their IPO price, so it's actually been a reasonable story. And so those are the kind of companies that we can help, and it's primarily, to your point, Nola, through our growth market AIM, where we help those companies list.
And speak a little bit more, Chris, about how a company would prepare to go public on AIM. What kind of directors do they have? Do you ask the venture capitalists to buy into that IPO?
Usually not, actually. I think this is usually an opportunity for the incumbent VC to be able to, even if there is no sell down as part of the IPO, and for a pre-revenue company that would be pretty unusual to see that, at least this is an opportunity to them to diversify funding sources. So they wouldn't have to backstop the IPO. And obviously, when you see biopharma IPOs in the US, it tends to be that they are backstopped by the either private or crossover investors that have come in prior to the company being listed. In the UK, that would be unusual to see, but not impossible. From a kind of structural perspective, you don't need to reinvent the wheel. We can take a Delaware incorporated company and list the ordinary shares in London. You don't need to have major surgery to corporate governance. You don't need to be subject to the UK takeover code. So you can still use US GAAP from an accounting perspective, so we can help companies almost as is and kind of just move them over and just use this as a platform for capital raising in the UK. And really what we're doing is we're helping smaller companies get access to high quality institutional capital at much lower cost than they could in the US public markets.
Great, that information. How about you, Chris? Can you tell me just a little bit about what you see trending with what you guys are doing at KKR now, even given the breakdown of the smaller regional banks that we've been talking about?
Yeah, and I thought Monica did a phenomenal job of summarizing a lot of complex information, both about the current state with some of the banks that were referenced, but also putting the current economic environment in a larger context. We are very close to what's happening in capital markets, whether that's equity issuance, but also on the credit side, whether that's bank loans, traded senior loans, or high yield. And I have to say that market has been effectively closed since Q1 of 2022. And so if you're either a company who's wanted to access those markets for primary financing, if you're an investment banker who's wanted to do M&A, or a private equity investor who's wanted to make a new sponsor-to-sponsor purchase, for example, access to financing all those transactions has been very difficult to come by, and it's showing up in a number of different places. I think it has a lot to do with some of the interest rate policies that Monica did such a nice job of summarizing, but it's also the case that there is uncertainty on costs and other inputs that have made it difficult. And then there's a technical dynamic that has to do with CLOs. CLOs are a market participant who buy a lot of new issues. We don't have to unpack that too much here, but as they become sidelined because of technical market forces, it makes it even harder for there to be new origination of syndicated loans and bonds. And so that entire market has been difficult. We had a window in February of this year of maybe 3 weeks where we got back to regular way. And now, of course, things are back on a pause. And I think that's going to continue to be an overhang. We would share the view that second half of the year feels more constructive, but there's a little bit of kick in the can down the road on that assessment as well. And I think we're reaching a place, and we spend lots of times with all the usual name brand healthcare sponsors that, they have finite investment periods, right? 5 years, 6 years. If you've been on the sideline for a year and a half, you're starting to worry about pacing and deployment. And so I think we will see a bit of a logjam break open here, but for the moment, things continue to be quite passive.
Yeah, it's a huge logjam. And Jeff, why don't you talk a little bit about how you can help companies in your advisory work? We talked a little bit about on our pre-call, one of the companies that had an IPO fail because E.F. Hutton couldn't get their act together. And you said you had some ideas around that.
So we, IPO is a great solution for a lot of different companies. And so we try to, as we advise people, we try to think about, what is the long-term strategy for the company? How much capital really is going to be needed to commercialize the technology or get to a stage where the valuation is just more driven by the business itself and not on the addressable market it can kind of attack. And so, we've worked with companies to explore different kinds of funding alternatives. Usually when it's not where the financing doesn't need to be broadly syndicated. When you get into that environment, you get a lot of the logjam that Chris was mentioning, and it has been impacting the overall statistics. So just kind of to point out a few numbers here, the number of M&A transactions, private placements over just kind of year to date versus the last 3 years on average, they're down about 40 to 50%. So this is real. Right? And so these numbers are coming down, and largely because of trepidation in the markets, but also just access to capital. And so I think there is desire and a need to grow businesses. So we often sit down with people, how do we navigate this? Now, we're often working with companies that are lower middle market. And so the private capital available to those kinds of companies are a little bit different. They're funds that were raised, sometimes 3, 5, 7 years ago, that have certain return dynamics and parameters that are actually quite favorable in the current, debt environment, which has escalated. And so they're trying to be a lot more aggressive. And so some of our clients that we're talking to right now are exploring private debt options more aggressively, even though they're going to be a little bit more costly than what they were hoping. It is a solution for helping them get through this kind of interest rate environment. So that's one. The other is just stretching things out. You're seeing a lot of headline layoffs within the tech industry, but you can also do the same by not hiring as aggressively. And that's what we're seeing with some of our clients, and advising them to just think about cash flows a little bit more dynamically. Can you hold off on spending that amount on those sorts of people and maybe outsource a little bit more, or partner with others in a way to stretch those dollars. And so we're really getting involved in those sorts of conversations right now too.
Yeah, and I would just build on that if I could, because I
Please.
think those are important points. Certainly the private credit community, and we are active in the private credit community, has gotten very large and sophisticated. There are players from small, under $15 million of EBITDA up through, as we're seeing with the Cotiviti headlines in the last week, up to quite large businesses, over $500 million of EBITDA that can fit in that lender category. There's also some increasingly creative, and you alluded to it before, asset-based financing options that can be available, which is really less dependent on the financial performance of the business and more a function of other capabilities or assets you might have. That might be IP, like royalties. That might be real estate. That might be contracts that you might have where you have some duration associated with it. Those can all be lower cost and often more certain financing alternatives that are worth exploring, particularly with specialty lenders that understand, this part of the market.
Yeah, just on that note, I think Chris is absolutely right. I mean, people are definitely going to be looking at specialty lending and in this environment, given what's happening in the kind of more mainstream capital markets. From our perspective, we actually have a number of vehicles that are listed in London which offer that kind of exposure. So, for instance, Royalty Pharma has a very large vehicle called Biopharma Credit, which is listed in London. It's probably about $1.5 billion in size, which specializes in that kind of lending. We also have a number of VC kind of funds which have listed. RTW has a listed fund in London which provides venture capital exposure to life sciences. We also have Syncona, which is a very well-known name that does that as well. So I think there are, in this environment, it's about looking for alternatives. I would love to say, if you're a pre-revenue life science company, that you could do an IPO tomorrow, but I would be a complete liar. And I only lie occasionally. So I think, looking at these alternative sources of capital in the special lending areas is definitely the way to go, especially as we talked about, with SBV's situation and First Republic. You're going to have to look at different pockets going forward, unfortunately.
Well, I know SVB acquired Lyric and then a Boston-based mutual fund, and they grew by acquisition as well as by deposits from technology. And I know that there's a loyal base of people in Boston that don't want it to go away. So I'm going to be really curious to see what happens in Boston, even though Silicon Valley Bank started in Silicon Valley. It's really got a following in Boston.
But I'll just say on that point, the SVB UK entity was bought by HSBC over the weekend, and I think something similar will happen in short order with the SVB Bridge Bank here, all parts of it.
Yep.
I'll be amazed if that doesn't happen very soon.
Yeah.
And I think the SVB Leering business is a business that will re-emerge as a separate entity as well. So I suspect that there will be some dislocation, and it'll be interesting to see what the ultimate owner of the SBV entity, how risk tolerant they will be, because that's the question we have about HSBC in the UK. Are they really going to be as forthright as SBV were in taking risk? So that remains to be seen.
Exactly. I remember the 1982 bull market started. And then we had a crash in 87, and we had a crash in 94, and we had the 2000 crash, and then we had the 2008. So I've seen a lot of cycles. And what I have also seen is bankers only know one way to wake up in the morning. That's put the pants on and go work as a banker. So they figure out another way to do this. So I'm encouraging everybody to be hopeful, because there's a lot of money out there that needs to go to work. And I think in the venture capital space, it's the best place to be right now, because there's no push to get your money out, and there's a lot of technology in the next 5 years that's going to change everything. Taking one of Art Pappas's quantum theories, we're going to really see post this year technology and AI and machine learning really changing the face of life sciences. So I'm just wondering, what kind of a company would you get excited about if they came to your door today to work with?
From a life science point of view, listen, I think whether you're talking about Merck at the very high end, a mid-cap biopharma company like BioMarin, which is from my hometown, or an earlier stage pre-approval product, the use of outsourcing the entire continuum from discovery to clinical research to market communication, market access, and through contract manufacturing has obviously become mainstream. And I think one of the places that, if I put my equity hat on for a moment, would be how can you build on that support infrastructure by leveraging some of the newer technologies and techniques that will only be additive to that. Because I think the realization, whether it's labor efficiency at the high end or access to technical expertise and quick ability to scale at the earlier stage is only going to be more appealing. We looked at a business very recently that was building almost a WeWorks-like facility that had embedded in it all bunch of core services for early stage development, including animal testing, right? So it became a one-stop shop. And I just think that sort of integration and that sort of ability to enable the acceleration of discovery continues to be interesting and with a lot of great inputs coming.
Thank you. How about you, Jeff?
We tend to be really excited about companies that enable more rapid development of products, and that's a broad ecosystem. It's all the services that Chris was mentioning. Better diagnostics, better AI kind of utilization within the process roadmap. The contract development capabilities, and then the sharing of those techniques with others, because they're not conflicted. They're just trying to enable. We like those businesses, and so those are the companies we tend to be talking to right now.
And how do you help them? What do you do if they come to your door?
Yeah, so we try to think. So we if you look at our logo, it's a strategy and then M&A, right? Because it really starts with strategy always. And so we always try to understand. Often when we're talking to a life science company, they get way too deep, way too quickly, and they don't understand the bigger picture. And so we try to take them back up and say, okay, what is the problem you're trying to address? How big is it? Let's quantify it. Let's see if your capital use really matches up with the ultimate prize. And so we try to help them think at a very high level. And even if we don't truly and formally engage with a client and they become a client of ours, we try to help them think through that, because ultimately one day we do want to work with them. Mm-hmm. So we understand we're not the perfect advisor for everyone all the time, but we do try to share that knowledge as we go. So what we at times formally work with someone to develop that go-to-market strategy, but at others we just try to identify a few things they need to think about, and they go back to the drawing board. So.
And if I could build on that, because I
Please.
think it's such an important point. I mean, no disrespect to all the founders in this room, but often founders, unless they're a serial entrepreneur, they don't know what they don't know. They might have come out of academic or out of another research or development. They might have a brilliant product, but the translation between a brilliant product and a successful, durable company is a very long and arduous path. And I think the sort of counseling that is being described is, in many cases, I think really make or break between, can you convert a lot of opportunity into the building blocks that get you into the sort of stage of financing and investor interest and ultimately exit that you are looking for, and also help to guarantee that your product or service or technology gets to the market, because misstepping on those things often means that your product won't get to market, or it won't get to market under your stewardship. Somebody else will step up, pick it up for pennies on the dollar, sadly, and roll it into their larger complex. And that's a lot less enjoyable or satisfying if you've been on the front lines of building something that's really unique in the marketplace.
And that happens all the time. And so, Chris Mayo, would you talk a little bit about how Brexit has influenced the AIM and the LSE?
God, I knew this was going to come. Actually, I moved back to the US. I was here from 1999 to 2007 working for Citigroup, and I moved back in 2016. And obviously that was the year of the Brexit vote. What I would say is that from my business, it's made very very little difference. Actually, we had a huge increase in the amount of listings that we had from the US since that vote happened. And that was just because we marketed the platform more effectively and said we can help small and micro-cap companies in the way the US exchanges can't, especially in areas like medtech, and we just made that effort, and we've had a lot of success stories as a result. When you actually look at the broader UK market, it still dominates the rest of Europe in terms of the amount of the capital that's raised, and I think that there's been some slightly odd PR that's come out that suggested that, say, France is bigger, or Germany or wherever, and it's not even close when it comes to the amount of capital that gets raised in the market. And also when you look at the size of the investor base, which is certainly UK mandated capital versus, say, French or German, we're talking, multiples of 10, 15 times bigger in the UK than it is in the US, not in the US, obviously, in the rest of Europe. And so that is the pool of capital that you are chasing, and it's still there. So I think there's been a lot of, and I would also say the FTSE 100, which is our main index, was up last year and outperformed the US indices. A lot of this stuff really doesn't get reported, and I think part of that, having lived here for a long time, is in the UK we tend to, have somewhat pessimistic outlook sometimes compared to our American cousins who tend to be a lot more optimistic and upbeat. And the scenario from a capital markets perspective has not nearly been as dire as people have made out. And for instance, I have a US technology IPO from New York on the road right now.
Oh, great.
Obviously, that's a revenue-generating company, and it's an EBITDA positive company. But it's a $75 million market cap company potentially, and that's just what we're good at doing. And those IPOs are still coming to us. So I think Brexit is a bit of a red herring. I don't think it was something that was necessarily positive for the UK economy. Now I think it's done. What do we do with it? But from a capital markets perspective, it has really been kind of business as usual since that happened, and the UK continues to dominate the rest of Europe from a capital markets perspective.
One last question of you. How do you build a book, and how long is the roadshow that the CEO has to go on to go out on AIM?
So I think for a smaller UK IPO, you'd probably only need to do a week roadshow, but you will have done a lot of engagement with investors before the actual roadshow proper. There's something which is referred to in the US as testing the waters, which is meeting with investors prior to actually doing your full IPO roadshow. That is actually a lot easier to do that in the UK than it is in the US. In the US, you would need to have a draft registration statement in place with the SEC so that your materials that you are showing investors, which the SEC will ask to look at, match the materials in the information in the registration statement. It's probably going to cost you $1 million to get to that point in the US, or certainly close to that. In the UK, you don't need to do any of that. You can go with a presentation. Maybe you get a lawyer to verify it, a couple of $1,000s to do that, and you can go and see investors as much as you want. But the point I'm really making with that is you have optionality. If you go to them and you don't like the feedback you're getting, this is right at the start of the process, you can say, okay, I'm going to do something else and look at other forms of capital or access to capital in other areas. So the UK has great optionality from that perspective. I would say for a large roadshow, you're going to spend probably 2 weeks on the road. The UK also still has something called deal research, which is a research report produced by the banks prior to the IPO, which is distributed to the main institutional investors. That was outlawed 20 years ago in the US by Elliot Spitzer. I don't know if you remember him.
Yeah, I do.
When he was New York Attorney General. So that isn't allowed in the US IPO process, but is allowed in the and in fact is central to UK IPO process. But really the point I'm trying to make is there are much more refined price discovery mechanisms in the UK because you're able to have that piece of research and also engage a lot more frequently with investors prior to IPO than you can for a US IPO.
So the bankers can talk to the analysts in the UK.
In most cases, yes. I'd say if you have a US-owned bank, they'll be a bit queasy about that. So, for instance, Stifel is quite active in AIM and also as a mid-market bank here. They'll probably be a bit queasier about doing that. I think if you have a UK-owned bank who's doing smaller microcap IPOs, the bankers and the research analysts will actually be talking quite frequently. So it is a very different environment than it is here.
Right. Go Go ahead.
Just to add on there, I think it's important to point out because what Chris is saying is really important. In the U.S., it is not economical to go public unless you're going to have a post-IPO market cap of 500 million or more. And on the AIM, they've made that possible, and it's a lot more economical, and it is a good strategy. Now, you can definitely go and you see IPOs here in the U.S. that are sub 500 million. I'm not saying that's not a possibility. It's just a lot more expensive, and it takes a lot longer, and there are a lot more regulations. And the U.S. kind of listings are at a disadvantage, and you've seen that over the last 20 years since Sarbanes-Oxley, especially. That we just aren't as competitive on the IPO stage anymore in the U.S. And that's unfortunate. It's unfortunate for us as investors too, I think, and I'll get off my soapbox. But from a business owner standpoint, it's important to know that this is a path, and it's a path that we advise as well, that people should explore that as an option for raising capital into that commercialization stage.
Can I pile on that point?
Please.
Would that be okay?
Go right ahead.
As a recovering sell-side analyst myself, I think another element that is underappreciated for companies and their shareholders is that, whether it's de-SPACing, to talk about a different era, or a small cap, micro cap IPO, even on a national exchange in the US, getting equity research coverage to really pay any attention is incredibly difficult. And what that means is 6 months, 9 months after the sizzle of the IPO is already occurred, when that Fidelity analyst says that's an interesting stock or an interesting space, how can I learn more about it? There's no research coverage. They move on to the next thing. And it becomes a very unvirtuous cycle in which you really can't get out from under the small cap dynamic. So I'm not here to dissuade people that think that's the right thing for their companies, but there are a number of important considerations that have changed, as you point out rightly. Regulatory and business practices have changed.
Yeah.
And I just say I don't want to mean to disparage the U.S. capital markets because, let's be frank, they're by far the deepest in the world. And there's lots of good reasons to go public in the US. I think there has been a move away from the small and micro cap arena, and costs have increased drastically. So, that's something that's not happening in the UK. We're still a lot more focused on small and micro cap companies, and it is much cheaper to go public and be public. But clearly the US is the deepest capital market in the world. So I want to make that clear. So that's why a lot of the companies we work with, if they're from the US, they will start in London. And then when they are large enough to get the kind of, interest and visibility that Chris McFadden is talking about, then they add the NASDAQ listing to add, another layer in terms of a deeper capital market and also increased access to specialist healthcare investors.
Yeah, and one additional statistic, biotech, pharma, life science companies represent about 80% of the public market activity in healthcare. So it is the majority of the public activity for U.S. listed healthcare companies. So it is still a viable avenue. So I don't want to disparage the U.S. market either. It just tends to be a larger market. So if you don't have the tech or the IP to go after a larger market, you may want to think about an avenue, if public markets are your avenue, that is more micro-cap as a beginning stage. So,
Yeah. I want to open it up to questions from the audience, if there are any. And I think that you've seen that this is actually an interesting panel for you here in Utah to have this kind of information. It's not usually given. So thanks, Kelvin, for putting this panel together and inviting me.
A question to Chris Mayo. What kind of metrics are you looking at in pre-revenue company to help them get listed with AIM? Thank you.
So I actually think it depends. We've been able to help companies that have approved products. We've also been able to help companies that are some years away from being in that position. But what I would say is we're typically not looking at biopharma, because biopharma, there's a lot of VC money for biopharma in the US. There is a lot less for other areas of life sciences, and that's where we think we can make a difference. So what we're typically looking at are companies which perhaps have a smaller addressable market opportunity. They will be closer to an approved product than a biopharma. So we're probably talking within a couple of years of having an approved product or service. And they're looking to raise more, I think, more modest amounts of capital. So we're typically talking between $10 and $50 million. So that's it's harder to be more prescriptive than that. But what I would say is that a lot of the life science companies we're talking to are outside of biopharma, and some of them have had VC money, some have had very little amounts. So usually angel actually money, and high net worth is where we typically see those opportunities. But the investor base in the UK is predominantly generalist. So what they want to see is a company that may have less upside. Obviously, they want to see upside. But perhaps there is more downside mitigation by being closer to an approved product and being a lot less capital intensive in getting to that approved product. So I guess that's the way that I would frame it.
A question for Chris Mayo. I'm familiar with the AIM market. I haven't followed it recently, so this is a respectful question, but I'm curious, roughly what percentage of the companies that go out on AIM actually wind up sort of treading in the shallows and neither alive nor dead versus the big markets? I'm not talking about a market reversal, but just they get there and then
I'd say not very many, and I think there's an important thing to say here. A lot of people in the US have, and I'll say I was a bulge bracket investment banker, so I had my own views of AIM, which I realized were out of date. In the mid-2000s, there was something like 200 AIM IPOs happening a year. A lot of those were coming from the US, and it was typically a company raising $5 million on a $25 million market cap, really small IPOs. A lot of those went to zero, to be frank. And a lot of those were most of them weren't in life science. A lot of them were in areas like mining and energy. So fast forward to today, we don't get 200 IPOs a year. In a typical year, we'll get 40 or 50 on AIM, and the company will be raising $30 to $40 million, and then it'll be on a market cap of, say, $150 million. So you'll see there's a very different character to that business than there used to be. And I get a lot of negative comments about people who remember that time, wherever it was nearly 20 years ago, where we weren't getting the quality. I think now we have a lower quantity, but we have much higher quality. And because you're raising $30 to $40 million, you're getting institutional capital, not retail. And that institutional capital is people that you've heard of: Fidelity, BlackRock, Schroders, those kind of names. So I think we're just looking at having, better quality and fewer IPOs. And then there is access to ongoing capital. So Renalytics, who we're talking later today, they raised a follow-on deals shortly after doing their IPO. And that's been the case for Bellascura and Maxite. So I think that there is a very different character to the market today than there was 20 years ago.
Okay, that wraps up our panel. Thank you to our panelists who've shed so much light on the world of funding beyond venture capital. And Kelvin, thank you.